Okay, thanks for tuning in. My name is Casey Lau, and also we have PC Wong here. We are the co-founder who actually put up the course called investforeignshare.com. You can check that out. And today we're going to talk about the energy cliff, and PC has actually prepared a lot of stuff to share with you. And also, if it is okay with you guys, I want to ask your permission. Can we share a little bit about investforeignshare.com as well? So about the cost. So at the end, we'll tell you a little bit about that cost. Okay, before we start, I'll like to introduce a little bit about PC. So PC is a best-selling author of this book, Invest in Foreign Shares. It was published quite a few years ago, and he also subsequently published another book called Invest in REITs as well, in foreign REITs, right? So without further ado, I'll let PC lead the session. He'll start with a disclaimer, and he'll show you some of the economic data that he had gathered about this topic. And then also we are going to talk about some stocks as well. And if we can have your permission, we'll talk about investforeignshare.com too. So over to you, PC.
Yep, thank you, Casey. And as usual, disclaimer, whatever we share here is meant for educational purposes. We are not financial advice. Nothing we share here is meant to be a financial advice. If you need to do any investment, please do your own due diligence. And today, our topic is the energy cliff, where we talk about the challenges and opportunities. Now, most of us are very familiar with the energy sector, but recent data have shown that the world is teetering towards an energy cliff, and it's very important for us to understand the reason why and how will it impact the global economy, and understand what are the opportunities that arise from it. So our topic today will focus on several key points. That is, what are the reasons for the energy cliff? How is it derived? How can the energy cliff alter the dynamics of the energy sector? What are the economic challenges as a consequence of the energy cliff? And energy transition and electrification of the infrastructure, will it be an answer to the energy cliff? Now, recently, there's a lot of people writing about the ESG economy and how we want to transition to the electrification of the infrastructure. And people write a lot about how solar and wind power would revolutionize the energy sector. But here, I'm going to show some arguments why they are an equal challenge and may not constitute an answer to the energy challenges. So here we talk about renewables and oil and how they stack against each other. Then we look at what are the opportunities available in the energy sector, given the challenges and opportunities. So reasons for the energy cliff. Now, some of you who have followed me in previous webinars may have heard about me talking about the EROI, which is the energy return on investment. Now, if you like the energy sector, I would encourage you to follow Steve Santangelo, and below is the link to his Twitter, where he writes a lot about the energy cliff. And most of the information that I learned, and also from other websites, will help you to understand more about the current energy situation. So first and foremost, the reason for the falling EROI is because it costs more to produce a barrel of oil today than it did more than 100 years ago. Now, 100 years ago, 1 barrel of oil used will produce 100 barrels of oil. Now, that 1 barrel is the energy required, okay, in order to extract 100 barrels of oil. But currently, the 1 barrel of oil can only produce 11 barrels of oil. That means that near surface oil has vastly been depleted, and it costs more to extract oil from an ever-increasing depth of difficult geology. We see things like last time, we have a lot of rigs that actually plunge into the surface of the earth, and then they extract the oil rather easily. But as the extraction continue, we are seeing greater depletion of near surface oil, and right now they have to go into shale oil, which are actually oil stored in rocks, which have to be fractured through fracking in order to extract the oil. Now, fracking is more expensive than the normal vertical drilling, okay, because fracking consists of horizontal drilling. And that is when shale oil also experience greater depletion, which means whereas the vertical drilling would actually consume less resources, and it can last longer because of a much lower rate of depletion. But shale oil can see a depletion rate of 40 to 50% from one year to the other. So that is the reason why we are seeing this bell curve, okay? Like previously, 1 barrel of oil can only extract 100, and then as it becomes more difficult and more challenging, 1 barrel can extract 30, and right now we are quite near the peak where 1 barrel can only extract 11 barrels. So even though new technology is used to bring oil into the market, we are actually bringing oil production forward from future generations. And this is because our consumption of oil or consumption of energy is what powers the global economy. All economic activities centered around the consumption of energy. If let's say there is not enough energy to be consumed, then naturally the global economy would stall or fall off or taper down. Now, the period from discovery to production has lengthened due to increase in difficulty in finding commercially viable oil. Now, a lot of people used to say that, Arctic oil is in abundance, but recent exploration by big companies like Shell, BP, and a few others, they actually have given up on the Arctic oil because drilling is already a challenge, and maintaining the oil production is another challenge. So that's why a lot of the Arctic oil exploration, a lot of the big oil companies have actually written off their investment to the tune of billions of dollars, because it's very difficult to drill in the Arctic. It costs a lot more. Now, those who are in the offshore oil business would understand that at a certain depth, a drill rig in offshore could cost easily around tens of millions, and in the deeper offshore drilling, it could cost as high as $250 million per rig. So that's why it's very, very costly. And we are also experiencing exponential growth in population, which will push the demand of oil higher. And according to the UN, the world's population is expected to increase by nearly 2 billion persons in the next 30 years, from the current 8 billion to 9.7 billion in 2050, and could peak at nearly 10.4 billion in mid-2080s. So that's like the global population over the next few decades will grow by another 25%. And because the population distribution is not equal, and a lot of those that are the population growth is experienced in either in developing economies or in very poor nations. And because of that, their only access to energy is through the cheaper version, okay, like coal and oil. Because to install wind farms, solar farms, or even nuclear would be very demanding on the government's finances. So even though countries are diversifying from using oil as an energy source, OPEC projects that global oil consumption will increase from 102 million barrels of oil per day in 2023 to 104 million barrels of oil by 2026. So the current emphasis to divert funding to the ESG economy further add to the difficulty of oil companies to secure funding to explore and develop fossil fuel deposits. So there's a lot of restriction because companies right now, their investability is being weighed by how they contribute to the overall development of the ESG economy. So it was not surprising that some oil companies even divest their refineries, okay, so that they have a smaller footprint in smaller carbon footprint, and then look into developing solar and wind farms. But if they dispose of their oil assets, that means that there will be lesser exploration being done, okay, to fill up the gap between exploration and production. So there's also the global supply imbalances due to wars and sanctions. And I think we see the greater impact since last year when the war in Ukraine erupted and subsequent sanctions on Russia. And then we see from that sanctions is that Europe is currently facing rapid deindustrialization. Why? Because the cost of energy suddenly went up. So the other thing is that the rate of decline in oil production has increased. Now, this is from JP Morgan, and based on their research on CEOs of oil companies, the rate of decline is averaging at 8%. Now, if the 8% decline starts at 30 billion barrels in 2015, at 2013, currently, based on the depletion rate, we are, at 50% of 2015, okay? And 2024 will see another drop. So Steve and Angela also came up with a very interesting chart. Now, from 1965 to 2019, oil production has gained 198.4%. But during the same period, oil depletion rate has declined, okay, by 707%. That means that the rate of depletion is faster, okay, than the rate of oil production growth. And if we continue along this trend, then we will see greater stress on the oil production, because when you have greater depletion rate, then oil companies have to find substitute deposits or find new discovery in order to continue to sustain their production. And if, let's say, they can't find enough oil to sustain the production, then that means the global supply of oil would actually be impacted. And if, let's say, countries still demand oil, but that's not enough oil, then oil price would actually have to go higher, okay, to encourage oil companies to venture out to more difficult terrain, okay, to conduct exploration, which are costly. And that ultimately will result in higher inflation. Now, the other thing is that if we look at it from the period of 2011 to 2021, total oil production is 320 billion barrels versus 76 billion of barrels of oil that is discovered. So you can see that how production has actually outpaced discoveries. And if we continue over the next few years, we will likely see that there won't be enough deposit to continue to fuel the global demand for energy. So how the energy cliff alters the dynamics of the energy sector. Now, of course, OPEC and Russia are protecting their margins to ensure that their oil and gas resources are not so cheap. So basically, you can see that even though that that demand from Europe is very high, okay, but then we don't see OPEC willing to cooperate and increase their production. Rather, they cut their production. So one of the main reasons is because, you know, especially Saudi Arabia rely on oil price being close to $100 per barrel to sustain its citizens' subsidies. Because Saudi Arabia has a huge amount of subsidy, okay, to for its citizens, it needs oil price to be maintained at a certain price. And if, let's say, the rate of discovery versus production, that's a huge gap, then even more is important for oil-rich countries to maintain their margin, because they do not know when the depletion rate would actually hit into their revenue. And as such, you know, oil-rich countries are looking at ways to maintain oil price at a certain level so that they enjoy the margin, and with that margin, they can use that proceeds from the sale of oil to diversify their economy. Because previously, the Middle East have been solely reliant on oil, okay, as a source of income. But right now, leaders in the Middle East are looking at ways to diversify their economy than solely relying on oil. But to do that, okay, on top of the subsidies, they need oil at a certain price so that they have enough proceeds to diversify. So Russia also needs oil and gas to sustain its economy, as the war in Ukraine will require more funding. And Russia just announced that it will increase its military budget by 70% in 2024. A potential recession, as many economists are expecting in the coming quarters, will be met with more production cuts. OPEC is not going to see the oil price. You know, if there's a recession, naturally the demand for energy would drop. But I don't think OPEC would be continue to pump more petrol, more oil into the market. Rather, I think they will cut so that, you know, they want to retain their reserves, but only selling to those that can afford to pay the price. And we can see that by their actions, like now they say that the cuts could be extended further rather than ending by the end of 2023. Now, this signifies that they have no intention, okay, to boost production to bring the price of oil down. Now, of course, the other thing that comes with it is a natural shift to renewable energy, such as nuclear, hydro, solar, wind, geothermal, biomass, etc. But building up a renewable energy infrastructure is not cheap and requires a mixed supply chain of raw materials and investment in technology, which has become increasingly challenging due to underinvestment in the resource industry and the sanctions. So, for example, China is the major producer of solar panels. And its solar panels are very cheap, but they are manufactured in Xinjiang. And because of the sanction on products coming out of Xinjiang, the Western nations are unable to bring the cost down. Okay, they have to rely on their own production, and that would actually make it more expensive. So according to The Independent in its publication on 8th of September 2022, transitioning nearly the entire world to an efficient and renewable energy system would cost nearly 62 trillion, according to the analysis by researchers at Stanford University. Now, herein lies the challenge. And it's not an easy feat. Why? Because many countries are heavily indebted. Now, according to the IIF, global debt has reached 307 trillion at the end of the first half of 2023. Now, that is already more than 300% of global GDP. If we look at it, by the end of 2022, global GDP was around 90 trillion in 2022. Now, given the G7 is mired in debt, the entire G7 government debt is expected to reach 127% of the group's combined GDP based on the IMF October 2023 outlook. So a lot of countries often see the GDP, the G7 as a group of developed nations, and even then, do not have that ability, okay, to go into 100% full energy transition as they agreed upon during the Paris Accord, because they are too heavily indebted. And even the G7 represents 44% of the global economy in nominal terms. They continue to power their economy with coal, gas, and oil, even as they pursue the ESG agenda. So it's not something that is so easily done. And because the amount of money that is required, the energy transition will likely to be very challenging. And it's not something that can be done very easily because of tremendous debt. Now, here are some examples why, there are certain cracks appearing in the energy transition. So, here's a headline by Reuters stating that Germany approves bringing coal-fired power plants back online this winter. And then we have in Britain, offshore wind auction appears to have zero bidders. So why does the UK want to auction its offshore wind farm? Well, basically because it's too expensive to operate. Okay, and then we have the French offshore wind farm developer files for bankruptcy. Okay, and then we see that solar panels ripped to the Nebraska or the solar farm in Nebraska, causing tremendous damage. So it's not something that is easily said and done, and there are tremendous challenges in operating wind and solar farms. So what does it mean? Now, it means that the energy cliff is driving demand for renewable energy, but the world does not have funding to fully transition to renewable energy globally, because the developing economies, emerging economies, and developed economies do not constitute the entire global GDP. A huge portion are still from poor countries and developing countries. So renewables will not be able to replace oil, gas, and coal in the medium term. It will prove to be more challenging in the long term, especially if we see the kind of events that are churning out currently, which we will discuss later in the current energy landscape. Now, the energy cliff will force inflation onto governments because of the demand for energy and the inability of future production to meet that demand. It will force inflation onto governments, and governments' protectionism will force hyperinflation on the population. We are already seeing it happening, during this current period. For example, when food prices rise, we have India banning the sale of white rice, and that caused the price of rice to skyrocket. So, and in other countries like in Canada, because of the energy transition, there's a demand for lithium, and suddenly Canada says that lithium is a national security asset, and then it forced the Chinese companies to, out of the lithium market, and then they say that we are going to develop it on our own. So because of all this protectionism, what will happen will then it will force the price of resources much higher, and that would be like the likely scenario, as a lot of countries will become very protective. Sometimes it's due to geopolitical tension, like right now what's happening in the Middle East, a lot of people are worried that it will be a return to the 1970s oil embargo, which the Middle East imposed on the Western nations. So energy cliff and impact on economy. Now you can see from this graph, okay, that there's a close correlation between oil consumption and the GDP per capita. Okay, you can see that it becomes very tight. Okay, this was during the period of the oil embargo in the 1970s. So higher population will naturally consume more oil due to the need for economic activities. If there's not enough oil for consumption, then naturally economic activities will fall. But to sustain that level of economic activities means that governments would have to stimulate more. And if they stimulate more, but there's not enough resources to sustain it, then the price of those resources would have to be higher. And that is what causes inflation. So here, you can see that oil price is tightly correlated with inflation if we look back since the year 2000. So this is because all economic activities are centered on energy, and oil is a primary source of that energy. You can see that using the US as an example, when oil price peak, okay, you can also see that inflation also rise in tandem, okay, as what happened. And this was during 2021, if I'm not wrong, okay. So oil price spike and then subsequently inflation went higher. Sometimes it will tend to overshoot because the price of oil rising and inflation is actually a lagging factor, okay. So in a worst case scenario, okay, hyperinflation could erupt if the energy cliff will force the price of higher, hence resulting in higher inflation. Because if the cost of extraction of oil becomes very expensive, so it's only natural that the price of oil will have to rise to make it meaningful for producers to continue to extract oil, because no producers would want to produce oil at a loss. Even more so when countries with oil-rich resources are looking at their budgetary constraints. So you can see that there's also a correlation, okay, between the debt and the oil and gas EROI. So falling EROI results in higher cost of oil production, leading to higher cost of manufacturing and services, as these costs need to be adjusted to the inflation. When government spends more than it produces, then it would need to fund its consumption through debt. So increase in debt would equal to increase in inflation. So you can see that when the EROI starts to fall, okay, it will bring with it higher costs. And in order to offset the cost, especially in the US, during the period you can see that there was a steep jump in the US debt, because during this period, okay, from 2000 plus onwards, China entered into the WTO, and China has become an industrial powerhouse. So much so that it is now the world's factory. And because the US does not produce as much as it did, okay, it has to import a lot of the goods from China. And when you do not have a manufacturing base and you continue to import, then the price of the goods will continue to rise as the cost of production increases because of continual demand for energy. And not only that, as the US debt continue to rise, the value of the US dollar would actually decline, okay? And if you look at certain charts, the US purchasing power has actually fallen by close to 90% since 1971, when Nixon pulls the gold out from backing the US dollar. So all this caused the purchasing power of the US dollar to drop, and as that increases, US dollar value declines, and the cost of commodities also will increase in tandem. So energy transition and renewables. So here we have a breakdown of the energy consumption in the year 2022 based on the million ton oil equivalent. So you can see that Asia has the fastest growth in energy consumption, basically driven by the manufacturing powerhouse in China and the strong growth in economies around Asia, India, ASEAN. So these are the primary growth areas of the Asia economy. And Asia, because of its growth, it needs to consume a lot of energy. So if we look at it, oil constitutes 30% of energy consumption, gas 23%, coal is 27%. Now, collectively, they already account for 80%. So whatever people talk about energy transition and such, it's still very far off, okay, in a very small percentage versus the fossil fuel. Now, at the end of 2022, fossil fuel constitute 81%, renewables at 14.2%, and nuclear at 399%. Now, fossil fuels is still the major source of energy for the world. Its share has dropped 5.7 percentage points from 88% in 1990. So it has dropped slightly, okay? Renewable shares has gained 7.03 percentage point from 7.18% in 1990. If we look at it, the increase is almost 100%. But it's because it starts from a very small base. It has yet to stamp its mark on the contribution towards the entire energy sector. So nuclear share has dropped 1.95 percentage point from 5.94% in 1990 because of the episode after the Fukushima reactor leak. So since that time, nuclear and especially the uranium market has been on a more than a decade long bear market. But that's a new revival for nuclear demand since 2020, and we could likely see that there's more investment going into new nuclear reactors. And I think about a year or two ago, we actually talked about the nuclear energy, and later I'll share what has been the result. So the transition to renewables will be costly. Many of the poor countries will not be able to make that transition. There is no other viable source of energy other than fossil fuels. And even rich countries are facing challenges in the transition to renewables. Now, one of the primary challenges is the cost of raw materials and investment in technology. When it comes to investment in technology with regard to renewables, there is no bigger share than China, okay, as this chart from Statista indicate. Now, China's development of renewable energy capacity outpaces the rest of the world. The next 9 leaders combined, okay, it is at 1.1 gigawatts. Sorry, 1,100 gigawatts. Okay, if we add all those together, I think it is slightly more than the rest of the 9 combined. And in 2023, China actually increased its renewable capacity by, I think, by a huge percentage, definitely, especially in solar, is closer to 100%. So China is the most advanced country when it comes to renewables, yet the West would not want to work with China where the costs are cheaper and the technology more advanced. So because of differing ideologies, okay, and because of the sanctions and such, the world is not cooperating together to bring down the overall cost. And because of that, certain places have higher costs, whereas China continue to enjoy cheaper costs. So if we look at it, how China's energy mix is going to revolve. Now, 2025, China coal expectation, China coal consumption will be 52%, but by 2060, it will reduce by 3%. Now, oil constitute 18%, but by 2060, it will be 8%. Natural gas from 10% will be 3%. Hydro from 8% to 15%, and wind 4% to 24%. Biomass from 2% to 5%. Nuclear 3% to 19%, and solar from 3% to 23%. So China is building up its infrastructure to be moving closer towards lesser dependence on fossil fuel. And the reasons are very valid, okay, because of geopolitical tensions. So for example, right now there's a conflict in Middle East. Now, China still import a lot of its oil from the Middle East, even though it has a long-term agreement with Russia on the supply of oil and gas. But assuming if there's a conflict that erupts in the Middle East, and if you are looking at the perspective of the media coming out from the US, it's like they are pinpointing towards Iran as the instigator through their proxies. So why Iran? Of course, Iran is an important land bridge in the BRI, the Belt and Road Initiative, which will allow China to import oil through the Middle East over land instead of normal route of shipping, because in a conflict with the US, there is strong indication that the US would actually have an embargo in the Indian Ocean through the Pacific Ocean, and therefore cutting China's access to oil. And because of that, you can see that China has escalated its renewables expansion this year, because as geopolitical tension continue to rise, China is making a move towards diversification of its energy sector. So in conjunction with that, China has escalated its wind and solar farm development. And over the next 10 years, China would build 150 nuclear reactors. So that indirectly is telling you where the investment destination would be, which we will explore later. So some hard truth about renewable. They do not generate electricity 24/7, 365. So solar farms are susceptible to periods of low solar activity or cloudy skies. Wind farms are susceptible to icing during periods of cold weather, which could damage the wind blades and turbine. Now, solar panels and wind blades are not recycled. They need to be replaced with which carry a high cost. Now, in the US, solar panels are classified as hazardous waste. Now, these are some images from the other media sources showing the graveyard of windmill blades in the US, and how solar panels are just forming a landfill. And because there's these materials, these solar panels or wind blades are not recycled, it will exert continual demand on global resources to feed the energy transition. So a lot of people talk about how renewables will be a game changer and such, but no one actually talks about the damage or environmental cost that it bears. So many ESG proponents highlighted how important renewables are, but no one takes into account the following. Now, the environmental damage due to solar panels and wind blades burial grounds in the absence of recycling. But right now, China has a committee looking into the recycling of solar panels because most of Chinese solar panels are expected to deteriorate in quality over the period from 2028 to 2030. So solar panels and wind blades and turbines need raw materials mined from the most challenging environments, far from any source of energy. The cheapest form of energy to mine these raw materials is oil. Now, no sane miner will build a solar farm to power the mine to bring the mine to production. So oil is essential for this operation because investing in a mine will cost anywhere from tens of millions to maybe more than 100 million. And if you need to bring that energy transition to the mine, it will like having to invest another tens of millions to build the capacity, then to convert all the mining equipment into electric vehicles, okay, or electric equipment. No one is going to do that. So oil would still be required in the energy transition. So, you know, it's just like what the EU says. The EU is a garden. We don't care if the rest of the world is a jungle, okay? Because the EU don't mine the resources for renewable energy in the EU itself. Most of it is mined elsewhere in the world. So that is what we call double standard, okay? Now, the same goes for nuclear plants. Uranium mining is very expensive, and nuclear plants need tremendous amount of resources and materials to build. Okay, the building of a nuclear plant can cost anywhere from close to a billion to $3 billion. So the resources and materials have to be mined, produced, and fabricated. Even the mining and construction equipment consumes oil. Okay, now we don't see in a building site, you know, people using electrified crane or things like that. Okay, so manufacturing plants which fabricates the materials also consume energy from fossil fuels. Now, the energy transition will require many more mines to be opened, increasing the environmental damage manifolds. And, you know, it's not because there is renewable that the damage to the environment caused by oil is reduced, okay? An extraction of resources, any extraction of resources is environmentally damaging, be it oil or minerals needed for the energy transition. So sometimes people think that if we get rid of oil, the world will be having a better environment. Not necessarily so. It may be better in terms of the calculation of the carbon dioxide emission, but no one talks about the environment damage. For example, lithium, which is getting more and more scarce, are basically mined in the driest places in Chile, where the amount of water is very little. So it's like you have to compete for the water that is required to process lithium. So this is an indication, okay, from Benchmark, which is an analyst in the resources sector. You can see that the amount of mines that are needed. Okay, so those that in the energy transition, you know, lithium, you can see that, you know, these are the amounts of mine that is required to keep the world to sustain its raw materials until 2035. And in cobalt, okay, you need dozens more mines, and in nickel, also the same, natural graphite and synthetic graphite. Now, natural graphite is going to be a challenge because China just imposed export restriction on graphite. So then there will be a rush into securing graphite resources. And without enough graphite, then the energy transition will also be impacted. So there's a tit for tat between the US sanctions and the Chinese sanctions as well. So there's tremendous environmental cost in order to achieve energy transition. So renewables versus oil. Now, according to the International Renewable Energy Agency, or IRENA, when it comes to the cost of new power generation, offshore wind and solar are now the cheapest sources of energy, even less than gas or coal. Onshore wind and solar with storage can cost as little as 4 cents per kilowatt hour, while fossil fuels can cost up to 22 cents per kilowatt hour. Now, this is the ideal scenario, but this is actually what happened instead. Inconsistency in power generation, especially solar and wind power. In Germany in 2019, wind energy went from supplying 59% to the grid on one day to as low as 2.6% on another. In the same year, solar peaked at 25% of the grid supply and bottomed out at 0.3%. So wind and solar is not a continual sustaining power generation kind of apparatus, because it can be due to having less wind or more cloudy skies, and then the impact on the power generation will be strong. Now, even with greater expansion of renewables, we cannot deny the fact that coal, gas, or oil need to be substitutes when renewables fail. So that was the primary reason why in the late 2022, there was a huge spike in the cost of energy in Europe, mainly because of not enough rain, and therefore causing the hydroelectric power generation to have a shortfall. And here, has already explained the shortfall in wind and solar farms. So energypost.eu brought up an interesting point where it stated that total energy usage, the gross final consumption of energy, can be calculated by taking production of energy in EU 28 or the Euro 28, adding the energy imports and subtracting the energy export. It can be concluded that the EU 28 currently uses about 1,600 million tons of oil equivalent a year to maintain its prosperity. But incidentally, this number neglects the energy which is required to create the products, for example, in China and elsewhere, that are imported by the EU 28. So here it states that it's very easy to say that the economy only requires so much power, okay? But never takes into consideration those goods that are brought into the economy to sustain the economy. So here it breaks it down. Firstly, the conversion losses in the energy sector, like power production, are not taken into account, okay? Secondly, the usage of fuel for international shipping is not taken into account. And thirdly, energy consumption for feedstocks are excluded. So, it's very simple to come up with a calculation that is done in a manner that support the ESG agenda. But if we look at how the economic tails, okay, are interconnected, and we take that into full account, then this work to around 1,100 million ton of oil equivalent per year. So this implies that a society with 100% renewable energy, according to this definition, will still require a substantial, about 50% amount of fossil fuels, because anything that is within the economy but is not produced inside the economy but still import from elsewhere need to be put into that calculation. So this is what energypost.eu is arguing. So many poor countries still rely on fossil fuels as sources of energy. They do not have the infrastructure to transition to renewables. Energy sources are localized to certain areas, and many parts of these countries remain without electricity. So there's recently have been a lot of talk about nuclear, and is nuclear the solution? Now, based on the emission of CO2, yes, nuclear has the lowest emission when compared to natural gas, oil, or even coal. And that is why there's now a rewriting of the rules, okay, in the EU, where Firstly, they were very aghast, in promoting nuclear because of of what happened in Fukushima and in Chernobyl. But recently, they have changed, okay, because nuclear technology has become more advanced, okay, whereas what happened in those were actually older technology. So there's a revival right now in the EU to promote nuclear energy because of this, okay? Nuclear has the highest capacity factor at 92.5%. So if you look at it, coal only has 40%, wind 35%, and solar 24.9%. Even though the cost for wind and solar, just as reported just now, is very low, but they are not operating against their full capacity, okay, which means 24/7, 365. But nuclear, they can do so, okay? So that's about 2 times more as natural gas and coal units, and almost 3 times more reliable than wind and solar plants. So because of the high capacity, there's a revival right now in the EU to promote the nuclear as an important contributor to the electricity grid. And on top of that, okay, the technology has advanced, okay, and nuclear will play an ever-increasing role in providing baseload energy in support of solar and wind energy. That means if, let's say, you have enough nuclear plants, if there's a shortfall in wind and solar, you can actually help to provide the baseload so that the overall economy does not falter, like what happened in the EU in 2022. Now, because of the spike in the energy costs in the EU, a lot of industries in the EU have to deindustrialize. For example, smelting companies which consume a lot of energy has to be shuttered, okay? And a lot of the high energy intensity kind of manufacturing have to be relocated elsewhere where energy is cheaper. So while it can reduce the demand for fossil fuels, oil will continue to play an important role, especially in shipping, air transport, polymers, and fertilizers. So a lot of people were saying that, okay, if we have electric cars and all those, then oil would not be playing any significant role. But I think, the improvement in terms of technology, especially in the development of synthetic materials, oil would continue to play an important role. Perhaps we will not see oil as being a consumable sometime in the future, but oil will be a very important synthetic material for us to improve upon the materials quality, especially in the next generation, we will see a booming space economy. So poor countries cannot afford nuclear power, okay, that is for certain because it costs billions of dollars, and therefore they will still rely on oil, coal, or gas. Now, the introduction of fusion energy could change the energy world, but it will take decades to accomplish. So there's a lot of talk that fusion is the next generation of energy, but so far, the longest record, if I'm not wrong, is held by a Chinese research team, where the continual fusion energy lasted, I think, just tens of thousands of seconds. Okay, so it's not enough to power something significant. But I think fusion energy may be something that is worthwhile to think about, perhaps over the next 2 or 3 decades. But definitely within this decade, I don't think it will happen. Okay, and if you take the example of the Chinese economy, they are planning to build 150 nuclear power plants. That goes to show, okay, what the Chinese government is anticipating in the future. Okay, and I believe that if you look at governments that have long-term planning, looking how the Chinese government is behaving would actually give you an indication of where that sector will be leading to. Now, what are the opportunities for the energy sector? Most importantly, we need to understand the current landscape. Now, the conflict in the Middle East, Lebanon, Syria, and Iran are the immediate targets. Could spread across the region, affecting global supply of oil, and Iran could close the Strait of Hormuz, which 20% of the global oil trade passes through. Now, Iran has stated over time in the past few years that any attack on the country will necessitate for it to close the Strait of Hormuz. And if let's say that happens, then there will be a shortage in the supply of oil. The other thing is the continuing war in Ukraine, which will not end until Ukraine becomes a landlocked country. Russia will likely secure Odessa, creating a land bridge to Transnistria, which is another majority Russian-speaking population. So Russia oil and gas will remain sanctioned indefinitely. US and Europe will switch to a war economy as production of military equipment and consumables are expedited, creating further demand for energy. Now, already we see that the war in Ukraine has necessitated Europe and US to increase their military budget, and so does Russia. And any war economy is actually not healthy for the global economy, because a war energy demands the shift of resources from manufacturing goods to manufacturing military equipment. Okay, and once you spend on manufacturing military equipment, okay, the only thing that is going to be blown to pieces, and that's the end of the economic cycle. But where goods are concerned, it is used by consumers who consume that that help consumers to consume more if, let's say, productivity increases, okay, and then if productivity increases, it will help to grow the economy further. Where military equipment, it just continue to drain from the goods sector, and therefore it will cause shortage of consumer goods in the market, leading to inflation. So high rate of depletion in production from US shale, oil and gas. Now, US rig count has fallen 20% year on year and 40% since 2019. So here is a chart by Steve and Angelo showing how the depletion of crude oil and natural gas from the shale basin. But of course, this is not the latest data. Another set of data shows that there is another peak because of a new discovery, but that itself, okay, would likely to deplete over the next 1 to 2 years. So here you can see that in just over a year, okay, natural gas has declined 32% and shale oil has declined 40%. So the rate of depletion is very, very high. So another thing that points to falling rig counts is that there are less fertile land, okay, that has deposit potential that is being discovered. So there is this pullback, that companies are not, they have not found new opportunities to explore for oil. So the other thing is that China is stockpiling energy commodities. Now, this will remove more oil from the market. China has also increased its coal import by 73% year on year from January to September. China signed a 27-year gas deal with Qatar Energy in November 2022. Here it goes to show how the crude oil imports in China has increased 12% year on year over 2022. Now, China, if for those who are still unaware, China is one of the top 10 largest oil producer in the world. And even though it's the largest oil producer, it is continuing to import from Russia, from the Middle East and elsewhere. In fact, China has signed some joint development, okay, with the Petrobras, which is the Petro Brasilia. So that goes to show, now China basically does not, has no intention to consume all of it. Most of it goes into the stockpiling because of geopolitical tensions. And the other thing is that there's a potential for another production cut from OPEC and Russia, if let's say the intention is to punish US and NATO for supporting Israel. So this is still being debated, but if let's say, okay, if there's a similar oil embargo like the 1970s, then oil price could surge. In the 1970s, the oil embargo caused oil price to surge by almost 3 times. So that is why there's a lot of parties right now trying to negotiate to bring an end to the conflict in the Middle East. And no one wants to see a 3 times surge in oil because that would mean skyrocketing inflation. And I think a lot of the countries, the major powers in the world are acknowledging this. Now, unless the intention is to crash the system, to have a new reset, with the introduction of more restrictive powers and also introduction of CBDC to reset the financial system, then I think there's no incentive for countries to see hyperinflation coming to their respective governments. Now, the SPR stocks, or the Strategic Petroleum Reserve, has declined 40.2% since February 2022, which was the onset of the Ukraine-Russia war. So Biden admin recently announced that it is seeking to refill its stocks by 6 million barrels. Now, 6 million barrels, of course, doesn't account for much. If we look at the annual consumption is like 100 over million barrels of oil per day. But because of production being cut, any attempt to refill the SPR would push the demand of oil higher. What if they are on a war footing and the 6 million barrels was just a early indication? What if they say they right now urgently need to refill, okay, by, you can see that from its peak of 500, just, you know, in February 2022, at that time, the amount of barrels of oil in the SPR was 581 million barrels. Right now, it's at 200 over. What if the Biden admin, in order to support an ongoing war, it has to refill the SPR by another 100 million barrels? Now, that would be like pushing the price, the demand for oil much higher. So 6 million barrels may not look as much at this point in time, but if let's say consistently done over a period, then it would have it would create a demand for oil. So any war will boost demand for oil, and oil price could surge as a result. The spillover will benefit gas and coal, as what happened in 2022. There's a shortage of LNG and oil, and subsequently, you know, you see Germany going back to coal. So for better part of 2022 to 2023, oil price has been suppressed by the release of the SPR stocks. There is little the Biden admin could do to suppress the price of oil further. Any attempt to refill the SPR will drive up the demand for oil. Oil and coal producers, oil and LNG shipping companies could benefit as a result. Later, we will show you what we shared with our members. Renewable energy companies could see mounting cost due to inflationary pressure caused by the surging price of oil and raw materials. So based on the current situation, it's best to ignore renewable energy companies. This can be seen just now as I show you a few news section, that a wind farm goes into bankruptcy, because the cost of replacement is very, very high, okay? And inefficient companies will be forced out. So because renewable is such a big name, everyone suddenly want to start their own renewable energy. And when there's too many production, it creates a pressure on the demand of resources. Someone has to outbid the other party in order to get the resources, and that would drive up the price of resources and therefore making that production very inefficient. So uranium producers and exploration companies, due to major investment moving into the sector, and nuclear is seen as a major solution to many of the world's energy crises. And another thing is that the supply deficit in uranium over the next decade will boost uranium price. I share with you some of the findings afterwards. So utilities, while not offering huge growth in capital gains, would be ideal for long-term dividend play. And right now, for example, a lot of the utilities have seen their price being down, okay, because of the volatility in the market. So if, let's say, continual volatility will actually force the price of utilities lower, then if you are keen on dividend play, then it's best to start measuring their yields against the share price. So let's talk a bit about IFS. We have been sharing our research for a very long time, and IFS, we study global economic, financial, and commodity trends, government policies, and how they could impact specific industry. So here we perform case studies on companies which can potentially benefit the trends. So I would like to share with you that we started to look at oil very much early. In fact, on 11 June 2020, we shared with our members that the time is right to enter the oil sector. We featured Shell and Chevron in our case study, and both Shell and Chevron has gained 118.6% and 89.5% respectively, including dividends in 40 months, or 35.6% and 26.9% adjusted annually. Then we have been long in uranium for a much longer time than what the hype on uranium started last year, okay, the beginning of last year. So we started to share the potential of uranium with our members on the 2nd of February 2019. We featured energy, fuels, and chemical. Now, both energy, fuels, and chemical have gained 215.4% and 162% respectively, including dividends in 57 months, or 45.3% and 34.1% adjusted annually. In fact, energy fuels actually gained much higher in 2021. Okay, right now it's hovering at around $7 plus, but at one time it went as high as $14. Okay, so that could be many times the return, because we share energy fuels when it was just less than $3. So we also featured Boss Energy, another uranium company, in our case studies on 9th of December 2021. So Boss Energy has gained 85.4% in 23 months, or 44.9% adjusted annually. So not only in the uranium or energy sector, we also look at opportunities in other types of sector. So we featured core packaging in our case study on 23rd of June 2022. Now, core is a packaging company that packages food listed in Hong Kong. So core packaging has gained 88.6% in 16 months, or 44.9% adjusted annually. So because of the energy crisis in Europe, okay, starting in 2022, we did a study on Gaslot Partners and Mitsui OSK in our case study on 13 October 2022, which we featured LNG shipping. Now, Gaslot Partners and Mitsui OSK has gained 89.5% and 56.7% respectively, including dividends in 13 months, or 82.9% and 52.5% adjusted annually. And as an IFS member, you also receive a weekly update where we talk about those companies, some talk about the market. We talk a lot about the gold and silver market because of the it being a safe haven. So in our portfolio weekly report, okay, we also highlight certain events which could actually have an impact on the some of the stocks that due to changing dynamics in the sector. So here, after we found out that there is an increase, okay, in the internet data center, cloud computing, and Internet of Things in China, we featured some stocks that that if the members are keen, they can start monitoring. And after our post on 22nd of January, China Mobile has gained 21.8% plus dividend, China Unicom 3.3%, and China Telecom 14.5%, including dividend. But in fact, we highlight China Mobile much earlier than that, in the year 2021. Yeah, late 2021, when it was just $49. When we highlighted this, China Mobile was around $56. If let's say, based on our earlier highlight in 2021, based on $49, the return would be much, much higher. And then I also, when I take certain position in the weekly update, I would also show what position I've taken. For example, here I mentioned that I bought shares in CNOOC, okay, at $11.60 per share. And since the notification on 24th of February, CNOOC has gained 29.9% plus dividend. And then here's another uranium update, which I sent to members, indicating that I've bought a position, and based on the current price, it has gained 170.2% over 33 months, or 61.9% adjusted annually. So these are what we do at IFS. And if you are keen, you can register as a member. You can follow me at my Facebook link here, and you can email me at this address. Just share what is IFS all about. So if you go to our site, you can see about some of my earlier trades, okay, and you can also understand some of the modules that we share, some of the testimonies. In fact, we have a lot of modules already in our history where we talk about specific industry. Here are what the modules are. We have talked about specific industry like the oil and gas, in the mining industry. We have talked about the nuclear industry. In fact, the amount of nuclear information that we have is a lot. There's a lot of companies we talk about in the nuclear industry, uranium industry. Then we talk about REITs. So it has a very wide database which you can look at. We talk about the economy. We talk about potential of US housing troubles and all those. It has a wealth of information. So if you like what we do, okay, do visit our website and and explore what we have to offer. So, any questions?
Okay, awesome. So thanks, PC, for sharing all this information. So since everybody are here, can we have some Q&A answered? And guys, if you need to ask any question regarding PC's presentation and also even about IFS, you can type in the Q&A box or even in the chat box. So far, we haven't received any questions. So if there's no question, we're going to end the webinar very soon. Just give you some time to type the question here.
So just to add, I think we are entering into a position where things will be very tough on the economy in the coming, not only this year, but in the coming next few years. In fact, I think if we are seeing any breakage in the financial system, which I think there is a high indication, if you have been following how the US bonds behave, you will see that the bonds yields have actually increased tremendously. It goes to show, because bonds and yields are inverse to each other, that means US Treasury bonds are actually depreciating in value. So normally in a high yield, you have high US dollar, and because of that, you will have lower price of major commodities. But in the past few weeks, we have seen gold and silver rising and oil as well. So these are very key and important assets. Oil because it's energy driven, precious metals because they are considered a safe haven. So this is showing you some breakage in the system, because normally if let's say yields are high, then there will be a strong US dollar, and strong US dollar will often reflective on the commodities, forcing the price of these commodities down. But we are not seeing that, especially in oil, gold, and silver. So there is certainly some breakage, okay, and that is also showing in the in a lot of key economic indicators, especially in the US, where a lot of the indicators are showing negative data. So it's going to be very challenging, and that's why we talk about energy, so that which I think that will be the place to be in view of a lot of the stressors in the global market. So if there's not any question, thank you, Casey. Thank you all who are logging in, and do visit our website to see what we have to offer. And thank you, Casey, for hosting. Bye-bye.